All right. It's been a couple days since I've logged on. I've been watching X, looking at all the news. A lot of craziness happening out there. We get a whiplash from all the rates. You get tariffs. You get the markets, bond market going crazy. Nobody knows what's going on. I've got a theory out there, and I'm just going to call it Professor Obvious here. And it was a post I saw on X, and basically, what we're seeing is kind of an inverse of what we saw during the whole what do you call it, COVID thing. So when everyone was back to work, let's see, everyone could work from home. So that changed the whole housing market dynamics. So everyone fled kind of that Midwestern, the New York, the East Coast, all the way to Minnesota. That whole Rust Belt moved south, right? They could move south to lower tax areas, to warmer weather. They could work anywhere in the country. So with the low rates, that caused a flood in those markets in Texas, Arizona, Florida, right? Those were huge boom markets. We saw prices just absolutely skyrocket in those markets, and prices went up all over the country, right, with the low rates. But now what's happening is the rates shot up, which is obvious, right? And then the other thing that no one's really paying attention to is these companies are calling people back to the office. So that incentive to work out of state is gone, right? All the short-term rentals that people were buying as owner occupant, mortgage fraud. Everyone's talking about the mortgage fraud, the FHA moratoriums on foreclosures. That's going to hit the market, and then all the fraud on saying they're owner occupied and they were doing short-term rental investments. Those people are being called back to the office. So there was a post by, I think, Tenant Advisor. So major companies are choosing to structure over workplace flexibility. So 56% are requiring 2 to 4 office days a week. Only 17% allow flexible scheduling, and just 2.5% will stay fully remote. 3 days per week in the office is most common mandate among companies, followed by 5 days. And this was a poll from like the top 200 of the Fortune 500 companies, right? And that's starting to have an impact on the smaller businesses as well. So as you had this wave of being able to work anywhere in the country, and then all of a sudden to be called back to the office, say 3 to 5 days a week, that's going to change dynamics. So let's kind of look at this. I got a few people saying hi. Thinking in time. Greetings from Chicago. And Robert. Hey, Craig. Hey, Robert. Okay, so here is the post of active housing inventory for sale compared to pre-pandemic levels. Metro shift between March 2019 and 2025. So here we're kind of seeing this play out. Let me see if I can zoom in so I can read it better. Okay, so I'm located in the Midwest here. So Chicago is sitting right around 0%. This is home price change between March 2025 and 26. I'm reading the wrong chart here. Here we go. Active housing inventory for sale compared to pre-pandemic levels between 2019 and 2025. So Chicago saw a 61% decline in house inventory. That's a huge decline. And look at the whole Northeast, New York, New Hampshire's up here, Vermont, you got Massachusetts. All this Northeast is down. Rochester, New York is down 73%. Cleveland's down 55%. Hartford's down 78%. Virginia Beach is down 56%. And then you go down to the Florida market, and that's up 89%. Memphis up 36%, Austin up 36 or 38, and San Antonio up 38, Denver up 43. So that's the inverse of what we experienced during COVID. So what we're just kind of seeing a reverse back to the normal market dynamics. So a lot of people rode this high wave and made a lot of money on appreciation. But now I'm thinking that's going back to people are going back to work. And we're experiencing that now. It's been 5 years. We had a few years of riding that, being able to work anywhere remotely in the country. That's changing. So the housing needs are changing. And we don't see this yet in any of the stats from like the moving companies. We might see that in like billing of cell phone records. This is just kind of a theory. It was just a chart I saw, and it seemed like Captain Obvious or Professor Obvious to me that, yeah, people have to go back to work. They're leaving their rental properties or whatever, their short-term rental or their houses down in these markets. Plus, while those were booming, they added a lot of inventory into those markets, a lot of free money out there. So you had a lot of syndications, a lot of builders throwing out specs. So they overbuilt in those markets, and I think those markets are going to get hurt. And I think Zillow is looking at this as like a national housing market. And the only time we were really a national housing market was during the Great Depression and during the GFC. And those were structural problems. I don't think this is a structural problem. I think we just had so many people move, relocate, and then relocate, and they're relocating back. So that's my theory. There's one flaw in my theory is the sales volume is still down in these markets, right? That the demand is there, but the demand destruction isn't as bad as in other areas. So you can have two things that are true going on at the same time. You can have demand destruction from higher rates, and then you can also have demand destruction from having to relocate back to other markets. So I think that's what we see going on here, and why those markets have an increase or decrease in inventory, where the previous boom markets have a decrease or an increase in inventory. I keep flip flopping those around. So those were my thoughts today. I know Trump had kind of shaken the ground saying he wanted someone fired. And so I don't know what the bond market's doing later today. That was first thing this morning. Last I checked, rates were steady, sitting around 6.5% for owner occupant purchase rates. Let's see, tertiary markets like Oklahoma City, Tulsa, and Oklahoma City is increasing housing inventory. Okay, so that kind of proves the thesis then, Robert, right? If you have inventory in those markets, I'm guessing those markets were seeing not as much appreciation or speculation during the whole COVID, right, when everyone was relocating. The slower metros, yeah, let's see, the slower metros, I think most of Florida and a lot of the coast here are hurricane related, a lot of damages from the hurricanes, and then insurance issues as a result. So they're getting whammied by people moving back. They're getting whammied by high interest rates, and then also huge insurance increases or inability to get insured on those properties. Plus, they had built a fairly amount of oversupply. The builders were expecting this boom to go on quite a while and may have overbuilt in some of these markets. So I think that's what we're experiencing in those markets. And then the lack of building that's been happening up in the Northeast and Midwest, that whole Rust Belt. And I think that Rust Belt may get some manufacturing back with these tariffs. Others will disagree and say the manufacturing's never coming back. I think it will, combine with some, not just tariffs, but some tax incentives. They're floating the idea of giving a tax credit to if you buy a car made in the U.S. So then maybe we'll pull in some of the Detroit may get some manufacturing back from all the jobs that were shipped over to Mexico assembly. So maybe some more will be assembled in the United States, provide more jobs, and then people will get tax credits to purchase those cars. And then maybe some European models and some Japanese models will manufacture in the U.S. as well. It is a global market. We're never going to change that. But we did hollow out our manufacturing base. But I think overall, if you had to look at where the growth will be, this is speculating out a few years, but if you're going to build a new plant, I think you have to be in that Southeast where they built new power plants. So that South Carolina, I think Texas built a few too, somewhere where you can get cheap power for manufacturing. And then what does Robert say? Robert's Oklahoma's talking about generic drugs too. I'm not sure about that. Are they talking about manufacturing drugs there? I mean, that would be huge, if we could make our own pharmaceuticals here rather than having that relied on other countries that may not be that friendly. Oh, that's pretty cool. Keep me posted on that, Robert. That would be awesome. So that could create a lot of wealth in that area, a lot of income. You get one manufacturing plant. It's not just the factory workers; it's all the housing sector that's needed. It's all the services that are needed, the retail that's needed. So once you get some job growth, you get auxiliary job growth with it, but you usually need a base industry to trigger things off. And then once you lost that in Detroit, it just kind of imploded. We saw that in northern Minnesota. It became too expensive to mine that iron ore. So then they purchased iron ore from Brazil and South America. And elsewhere in the world, it was cheaper there to ship it in than it was to mine it locally. So I think as those start to happen, we may see some mining operations and logging coming back. So I think there is opportunity in the future, but I think we're in a rough spell here. So I just had these thoughts floating out there. I just wanted to jump on here and do a quick live stream. I should probably give you more heads up notice on this one. Robert jumped on. Thanks for doing that. Thinking in time. Thanks for logging on. Do you have any questions before I log off? I got to get back to work here. I just wanted to share some thoughts. Okay. So next time I'll try to give more of a heads up now that I got some people interested in talking. That's pretty cool. So it's easier to have a conversation than it is just to talk into an empty screen here. So and get my crazy thoughts out of my head. So, but that's what's rattling around up there. I think we might be reverting more back to a normal market than we had been. And I think this is a healthy transfer. I think that southern market might get hit and hurt, for a while as it works through lower demand and people moving back to their jobs. So that's all I got. So my workload's lightening up a little bit, so I'm going to hopefully be able to do this like once a day or once every other day and try to get a little better at this. And appreciate you signing in, and we'll talk to you soon. Have a good one. Thanks.